just whatever.
Okay, ladies and gentlemen.
I want to be a real estate developer.
May I have your attention? Thank you. And welcome to the last session here at the, first of all, thank you very much for MIT and ULI and all the affiliate sponsors. This is really a wonderful thing for you to sponsor at this era of the real estate cycle. But to change things up, our last panel, we've decided to discuss a more interesting topic, and that's the Red Sox chances of winning the 2011 World Series. That's my vain attempt at an April Fool's joke, but thank you. My name is Ken Munkacy. I'm with GID Investment Advisors here in Boston, actually across the street. And I'm serving as today's moderator. And the title of our panel is actually Around the World in 75 Minutes. And we have some great tour guides for you here today that represent all areas of international investing. And I'd like to take a minute to have them introduce themselves. Peter?
Good afternoon. My name is Peter Lewis. I'm a principal in the Real Estate Resource Group, and prior to that, I was responsible for the real estate investment program for Liberty Mutual, and I did real estate and real assets investing for MIT.
Hi, thanks for having me. George Oakes with JP Morgan Asset Management. Our group has a shade under $50 billion in assets under management. About 4 years ago now, we shifted from real estate to real assets. So while the bulk of our investments are in real estate, we migrated over to infrastructure, and just recently we introduced a global maritime fund, which we would say is basically warehouses on ships. So a lot like real estate, but looking at the direction that we see the alternative asset class going. Pertinent to this particular discussion, I spent years 2007 through 2009 based in London, working with existing clients and business development across Europe, the Middle East, and some in Asia. So fairly current in terms of what has been going on around the globe in terms of capital raising and real estate investing.
Hi, I'm Kevin Smith with Prudential Real Estate Investors. We have a shade under the $50 billion that George has under management.
Now, wait, hold on. When you guys talk about shades under, is this pre-Lehman or post-Lehman valuation?
These are current, very reasonable values.
Touche.
We have investment operations in the U.S. where we have about half of our assets under management, and also Europe, Latin America, and Asia.
Hi, I'm Mark Davidson. I work with AEW Capital Management. We manage about $43 billion of equity across the world, so I feel like the poor pauper on this table. Half of that is in North America, and the other half is overseas, with the majority of that being in Europe. About 20% of it is in Asia. I sit on the investment committees for anything that AEW does, either in North America or in Asia. And we're in every space, core value-added, opportunistic, as well as we have about $8 billion of public REIT securities under management.
Great. My name's Rob Gifford. I'm CEO of AIG Global Real Estate, and I was recruited to join AIG in the summer of 2009 after the government takeover. Prior to that, I worked with this guy to the right of me at AEW for a long time. Just in terms of AIG Global Real Estate, the nature of the task that I was hired to do was really more of a restructuring and wind down task as opposed to an investment task. So my sort of perspective is going to be a little bit different. When I joined a couple of years ago, AIG's real estate group had about $25 billion of assets under management. About half of that was principal capital for the company. About half of that was in third-party funds, where AIG was acting as the general partner and manager of the funds. And it really was a global enterprise with assets everywhere from Korea to India to Mexico, throughout Europe and the United States and elsewhere. Today, that $25 billion of assets, when I joined, is now under $10 billion today. We've engaged in a number of divestitures, including our whole Asia and Japan operation to Invesco at the end of last year. So, you know, I'm spotty and sort of very knowledgeable about some things, depending on where we are and where we've transacted. But unlike the gentleman to my right here, It's less of a new investment out in the market trying to place capital focus and more of a restructuring and exit focus. So there'll be some areas where I think I can add value and others where I'll probably take a pass.
Actually, they're probably buying up a lot of your detritus. My name is Ken Munkacy, as I noted. I'm with GID Investment Advisors. We're a Boston-based private equity real estate investment development and operation company. We have a shade over $6 billion in assets, mostly multifamily, that we venture with various institutional partners. I've been heading up the international area in India and Brazil for the last couple of years, and we're mostly into for sale residential and warehouse industrial as our asset class and focus. If I could just set the stage for this august body here. I was thinking on the way over that if Charles Dickens was writing his book today, he'd probably have a little different title and a little different spin, that instead of calling it A Tale of Two Cities, he'd call it A Tale of Two Markets, because really I think the world is increasingly becoming the haves and the have-nots, the distressed and the unstressed, the growing and the stagnant, and oftentimes those fault lines occurred between the emerging markets and the developed world. And he'd have a little bit different introduction, I think, to his book, and he'd probably start off saying, it wasn't the best of times, and it's not the worst of times, but almost. And in real estate, though, I think we're kind of cautiously optimistic. It's, I think, some of the themes you've been hearing today between and among the various speakers and programs. Last month, the Real Capital Analytics came out with an interesting summary that the U.S. was leading 30 different global markets in asset sales. There's 135 billion in asset sales, and 14 months ago there was small single digits, barely making a mark. But there's a lot in store in this year. Here it is. It's the beginning of the second quarter. It's snowing in Boston. We're playing our first baseball game tonight and down in Texas. But also, the world is reverberating from some pretty dramatic hits that we're all trying to make sense of in the real estate market. There's the Japan ecological and economic disaster going on, and here are countries in yet another war in the Mideast, and the northern African nations are in various stages of revolution and revolt that's disrupting various important oil supply chains, and the EU is struggling with Portugal and Greece and Ireland, and the U.S. business confidence this week was the lowest point in 2 years, and domestic housing sales are at the lowest point, second lowest point since post-Lehman. So, one of my economist friends like to say it might not be the worst of times, but you can see it from here. So, all that said, I think, there is job growth, and there are some, a surplus of bidders, and many of them sitting around the table here, trying to make sense of cap rates that seem conspicuously close to what happened in the pre-Lehman meltdown. And so I guess we're in a new investment paradigm, and I'd like some of our panelists to try and connect the dots for us. Mark, you've been at AEW for a number of years, and you've been through more cycles than anybody, I think. And it's a new era of financial dislocation, and I guess the threshold issue is risk being repriced, and if yield's such a scarce commodity, where are the real yields that you're seeing in today's environment?
I think first, the answer to the first question is risk being repriced. It's all how you define risk. I mean, I think as prior panel said, when you're in here, and I think the LIBOR rate is about 30 basis points for the 30 days, and the 30-year Treasury is, at 4%, the 10-year Treasury is at around 3%. People are pricing to that, and everybody talks, well, you price off of treasuries. Well, you should, as long as that treasury is real. No one has yet talked about, is it a medicated treasury and is at its natural point when I'll call it stimulus that's been pumped into the system around the world, is taken out. In my feeling, I think there's a little, in some areas, it's mispriced. And the reason why I say it is, if cap rates move and interest rates move, everyone should just do a simple math. How much does your NOI have to, at these cap rates, how much does your NOI have to move to stay even? And it's about 20% based on where cap rates are. And where I struggle is when you look at the economy, we are recovering, But the issues that got us to this point haven't been resolved, which is, in my belief, America has an income problem, that people don't earn enough to justify their spending, and that we haven't solved. And it's going to get worse only because every day you read the paper, whether it's Ohio, Wisconsin, any other state, we're in the world where we're taking things away from people, not giving them to people anymore, which means they just have to save more. So I just think growth's going to be slower. So to get the growth rates people need to justify their underwriting, I think it's going to be harder to achieve.
Okay, so we have two big institutional investors here, George and Kevin. Probably one of the big 900-pound gorillas in this room is, or any room in real estate, is that we've been having 30 years of artificially low interest rates. And this week the chairman of the St. Louis Fed, who's always a harbinger of things to come, is saying an end to QE2. Okay, so to Mark's point, we're very interest rate sensitive investors. How do you see, if it's mispriced now, what's going to happen in another 2 years when the rates keep going up and people are buying at 4.5, 5 cap rates today? I mean, isn't that just kind of kicking the proverbial ball down the road in terms of creating another problem and a bubble right now? That's a loaded question, but go ahead.
Yeah. Are you done?
Yeah. No.
Okay. That is the 64,000 billion trillion
pound
dollar question right now. Is kind of you can think of it as terms of a struggle between growth and where the price of capital is going to go, interest rates. And I think everybody, if we did a show of hands, everybody here would probably feel like interest rates are going to go up. Long-term rates will go up. It's just a matter of how fast and when. When we've looked at this question of the relationship between cap rates and interest rates as sort of pricing proxies for different parts of the capital markets, cap rates typically in a period of rising interest rates certainly don't react one-to-one to rising interest rates, and oftentimes go in the opposite direction. So because real estate has this inflation, at least a promise of inflation protection, when the level of economic activity is on the rise, you're going to get cushioned from that. Now, if interest rates go up drastically because people lose confidence in the United States' ability to pay its debts, that's a totally different thing, and then you're going to see a real flight away from any kind of risk. But in the normal expansion of the economy, and that's driving higher interest rates, which I think will happen, I don't think cap rates are going to necessarily just shoot back up one for one with interest rates.
I guess I agree with what was said, and I would just add one other thing, that we've seen this movie before. If you take a look at the relationship, say, between cap rates, now I'm not talking about a trophy office building in New York City, but generally reasonably high quality Class A real estate, and you contrast that with 10-year treasuries, you're looking at 350 to 400 basis points. Historically, that spread has come into 150 to 200 basis points before you begin to see a significant change in the cap rates of real estate. So we clearly have a pretty nice cushion, and that's happened previously. Well, ultimately, it will affect cap rates, but unless we see an absolute robust economy, and if I were to ask for a raise of hands of who all in the room believes that we're going to see, as somebody said earlier, this hockey stick sort of recovery, I'm sure we'd get no hands up. And so the likelihood of that happening, I think, is fairly low.
So, Peter, in light of what they're saying, do you see somewhat of is this a cyclical change that we're going through now, or is there something more fundamental and systemic going on here with how the relationship between our perception of risk at cap rates and interest rates and so and I'd throw also currency changes in there. How does that add to the mix of investors' perception?